G'day and welcome to today's podcast. My name is Robert Gowdy and I have with me
Amy Lehman.
Cool, and this is the Investor Motivation Podcast. Today, what are we chatting about, Amos?
Today we are going to talk about what you should consider doing with a lump sum of money.
So how would that come about? How would we get a lump sum of money?
Well, there are obviously many ways that it could happen. Could be an inheritance, could be a windfall gain, it could be a capital gains event where you have a great capital gain and are left with a big sum of cash.
Right, so it could be inheritance from family estate, just a windfall of some type.
We'll cover off on some of the tax consequences depending on what kind of gain that is, but otherwise it's going to be, just some of the things that you really should be considering when you do come into that lump sum of money.
Right, yes. Yep.
The first steps.
Yeah, and probably one of the bearing any capital gains outcomes. Sometimes there are some timely things you need to get right. So sometimes you need to act fast to make sure you can mitigate capital gains tax.
Yeah.
But mostly you need to be able to take your time as a starting point.
Yeah. When it's considering what to do with the funds.
Yes.
Once tax and everything else has been considered,
Yep.
that part is definitely the slowdown. Once you've done those timely things, and then think about next steps.
Yeah. Okay. So farm sales, obviously that's a classic one in our area. We're in an agricultural area here in Horsham, country Victoria. People sell a farm. We are talking millions of dollars these days, and fantastic. So. We don't deal with many people where it's been Tattslotto win or something exciting like that.
A couple, but often around here it is that farm sale, and that's when it has that timely aspect to begin with.
Yep.
To make sure that the capital gains is really neat and tidy, and then it's what do we do with everything else now?
Fantastic. All right, before we kick off, the acknowledgement of the land, please, Amos.
Yep. On behalf of the Investor Motivation Podcast, we would like to pay our respects to the elders of the land on which we are recording today, and pay our respects to elders past, present and emerging.
Cool. Well done, Amy. Thank you for that. So probably it doesn't have to be in exact order, but probably the first thing that I think about when people get a large amount of money, and a large amount of money means different things to different people.
Yeah.
Yep. So $100,000 can be that is a large amount of money.
Absolutely.
So $50,000 is a large amount of money. So we're not not trying to exclude anyone to say, well, unless you're talking about a $5 million farm sale or something like that, it's not important. It's absolutely important.
Yeah, absolutely. Yep. And I guess back on the timely aspect of things with things like the farm sale, it does have that moment where you sell the farm, you've got the proceeds, and then you do need to consider all of those capital gains aspects, and that needs to generally happen in the same financial year as the transaction occurs.
Yep.
So with those things, that's when that timely aspect comes into play, and you should seek advice from your accountant, number one, and your financial advisor.
Yeah, and that's where, for some of that more complex business sale, so not just farms, business in general, that these things are planned out over a number of years prior to the transaction, and you know exactly what steps need to be taken to make sure that you do not, if you're eligible for carry forward concessional contributions, to make that work for you the year that you get the big capital gain or the big income event, that they are utilised, particularly before your super fund is loaded up and it takes you above $500,000. So there are some instances where you need to be organised, and you need to be timely with super contributions particularly.
Yeah, absolutely. That is a great example of, and it's true as well as for people that have multiple investment properties and they want to plan on how to progressively sell that down to mitigate that capital gain as much as possible. And that carry forward is one of the best ways to be able to reduce any capital gains. So making sure you time things right to be able to use those contributions before that over 500,000 super balance.
Yeah, we just did some work this morning on a couple where we are looking to liquidate 3 investment properties, and we've been able to, using the carry forward, make sure that the maximum tax rate they pay is 15%.
Yeah.
So it's a very good outcome. Okay, so we've set aside all the timely issues at Amos. Now, is this where we need to engage patience, which is a famous quote to me that I came up with, and I'm driving into Melbourne, and all of a sudden it gets bumper to bumper. We're not used to that in country areas, but and I think I randomly said time to engage patients, and Amy liked that one. It was,
I do. It's quite a common saying around here now. In case you hear anyone tapping their fingers or tapping their toes, you go, "Do you need to engage some patients?" But yeah, you are very well right. Once you do have that capital gain stuff out of the way, where those tax considerations need to happen in the same financial year or whatever the time frame might be, that's when you can take a breath, slow down. The cash is hopefully in a account, and hopefully that's a high interest savings account if that's a large sum of money, and you've got time to educate yourself, speak to the right people, and understand your options moving forward and what the best option might be.
Cool. All right, you mentioned very briefly a high interest savings account. Let's break that down a little bit further, and then we'll jump back into the education, the knowledge building part. But if you go to one of the big four banks, they'll more than likely it'll fall into your trading account, and that could be 1%, 0.5%, 2%. We see this all the time. That
dismal.
It's a dismal return. At the moment, you can get at core, at least 4.65. A term deposit at close to 5. They've eased off a little bit of late because there is anticipation the interest rates will come down. But we are talking about 4.5% plus. That's a good rate. It's risk-free and it gives you time.
Yeah, absolutely. And we've seen clients that have, and it does depend on that sum of money. Some of these savings account might only do that 4.5%, say, on the first 100,000 or so. So some people are going to multiple accounts, but otherwise short-term term deposits are still also good if you want to get a 3 or a 6 month term deposit, knowing that there's no rush, and especially true right now because of the volatile markets we're in and the huge upswing that we've seen. We're in no rush to put lump sums of money into these very highly valued markets.
We'd actually be barracking for a bit more volatility on the way down.
On the way down, please.
Terrific. So you get the money, you've organised the tax, your tax saving strategies with your accountant, your financial planner. Now it's time to lift education and knowledge. So what, I suppose, when clients come in here, what does that look like? When I'm advising people, what does it look like from your point of view, Amy?
It does depend a little bit on what the circumstances are that the clients come in. If it was a farm sale or a business sale, because that person's been in business, and shares are generally, as we go through the education piece, the better return asset class to be in. So when it is farm sale and business sale people, they generally have a really good understanding of that so fast, but we still take them through that whole education process of different asset classes, different returns historically, and we really go through all of that education to make sure we're all on the same page moving forward and in agreement.
So this is where to invest, where not to invest, what structures to invest into. It's all the things that we'll cover off here, but it's just making sure that clients have an understanding and are making good informed decisions. And I think if people have an understanding, a patient, take their time, lift knowledge, then the next steps won't feel scary for them. But if you're just flying blind, trusting someone, geez, I hope they're doing a good job, I hope they're trustworthy, I don't think that's not the position that we want people to be in.
No.
I understand what you're doing, Rob and Amy. Now go ahead and do it. And then that allows them to focus on actually the stuff they really love.
That education journey can look different for different people. If someone's come in because they've got a lot of investment properties and they're used to properties historically as the way to grow their wealth, and they've done well in that area, that's a bit of a relearning for those people sometimes, because there's always going to be biases with any investor, and that bias generally is that property's where they need to be moving forward because that's how they've built wealth. So it's re-educating people on what else is available to them and how it might be more beneficial.
Great. All right. So we broadly start with obviously patients, then education. From there, I think the next focus for me, we need to work out what is the tax structure.
Yeah.
When it comes to tax structures, we're trying to find the best way to make sure that people pay the least amount of tax as possible legally.
Yeah, absolutely. And I think we've talked about it a million times on the podcast, so if you're a regular listener, you know, but superannuation is always going to be that number one area if you've got a lower balance at the moment, and we can bolster that up as much as possible. 15% tax in accumulation and 0% in pension phase, up to 1.9 million.
Yeah, per person. That is $3.8 million that a couple can have in superannuation if you're lucky enough to have that amount of money in super, and you can get it in. Obviously, there's all the strategy and planning around that. Nearly $4 million completely tax-free.
Yeah, absolutely.
So that is probably the gold standard.
Superannuation.
So we work out the tax structure. From there, we may consider just investing in joint names.
Yeah,
just a husband and wife, joint names. Really simple.
Yeah,
but it depends on the amount of money. What can't we get into superannuation?
So up into superannuation, as we mentioned, pension phase is that 1.9 million, but you are limited to how much you can actually put in one hit in any given financial year. So that's where your financial advisor will look into that carry forward amount and your non-concessionals and your bring forward ability. So all of these different strategies we won't bore you with today.
Small business capital gains, exemptions, which allow us to put in some really big numbers into superannuation potentially. If you meet certain criteria, but small business capital gains exemptions are just too big a beast. But let's say we max out whatever we can get in there up to the 1.9 and above if we can. And if there is substantial money outside, that's when we look to might be family trust, which allows people to distribute money, income and capital gains to many different beneficiaries. It might be an investment company where you pay tax at a maximum of 25 or 30%. Again, it depends on the amount.
Yeah, it definitely does. And the amount of just regular salary and income individuals earn in their own right without considering future earnings of that lump sum as well. Yeah,
absolutely. Yeah, so if people, if they've got a very large lump sum early, which brings in a lot of tax problem, and that goes on top of their taxable income, then will a family trust help a heap? No, you can only distribute to the same people. A company at 25 cents on the dollar might seem really attractive. The other thing that I've run a beneficiary company for many years, I don't need to distribute from it. It can retain its earnings. It pays its 30 or 25% tax. You don't have to distribute. A trust, you have to distribute earnings, income and capital gains out. Cool. All right, so we spend time in educating around where, what structure to invest in. And I think it's worth mentioning that when markets go down, people will blame superannuation. Superannuation is a terrible investment. Superannuation is not an investment. It is a tax structure. How you invest within superannuation is up to the investor.
Absolutely.
Cool. So what's next after we work out the tax structures we would recommend for a client?
So hopefully by that point, if they've had conversations with us, the education level is lifted, you know what asset classes we're leaning towards, the tax structure is right, and then it's really about being patient again, especially if they're clients of ours and we've educated about being into businesses, into the share markets. So it is again about being patient at the moment.
So it's about where do we invest? Where, we've just sold this big asset or we just inherited this big amount of cash or whatever the scenario is. What next? So what investments? So it's where to invest, but part of the education is also where not to invest?
Correct. And as we mentioned earlier, especially true for when people come in with large biases about, properties where I've always been and properties where I need to go moving forward. And you get asked, what do you think about Sydney at the moment and what do you think about Melbourne for the rental market? And we're never going to even pretend to dabble in that area and try and pick hotspots out.
And in addition to, what do you think of gold, Amy? What do you think of silver?
Bitcoin?
There's just... So we often talk to our clients about where we go and why, but there's so much more out there now, particularly for the younger generations coming through. There's so many people at us, not saying I'm in the younger generation either, but there's so many people at us, that calling that crypto is investment quality.
Yeah.
It's insanely not investment quality.
Yeah.
But how does someone know that? And that's where time spent understanding what investing looks like.
Yeah.
Where to be and where not to be and why.
Yeah.
And that's that education point. Lift knowledge, feel comfortable
Yeah.
that you're making the right decisions for the coming decades.
And yeah, as we do take clients through that education journey, we'll do a risk profile as a part of that, where we do as much education as we feel we can give, and then at the end of that, let's do the risk profile based on everything we've taught you and everything you've absorbed. How comfortable are you with volatility, and how much do you want in conservative assets?
Yep.
So then that's where we really get the understanding of what to invest in.
Great. So we've got to a stage where structure is set, patience is engaged, tax is saved. We now know where to invest. We've put recommended portfolios for our clients.
Yep.
We're exactly where the money's going to go. We take all the money and invest it all in one hit, Amy?
Right now, no.
No, we don't.
No. Well, not really ever, do we?
No.
No.
What do we do there?
So we're progressively investing. That's engaging ultimate patience. Cash and the conservative assets, they can go in one hit because that's the conservative market. We don't need to worry about the volatility as much there. But with the volatile assets like the share market, we do want to be patient. We've got processes in place within our business here, within our investment committee here. So when the markets reach certain points, we have triggers to buy, and otherwise we're pretty much holding still unless we find an amazing business that's trading at a very, very appealing price.
Yep. So a bit of cherry picking. So there would be times where we're not being patient and we are just investing, and those things we've already formalised with our business. We know that when we will just say, no, we're not progressive, we're not dollar cost averaging, we're just getting it all in because, and the telltale sign for that will be when everyone's really scared. When the share market's a terrible spot to be, that's when we'll get more excited about it. So I think it's fair to say that when it comes to investing, there is this financial side of it, where to invest, the analytical side, the balance sheet, the profit, the sector, all these things, and then there is the emotional, psychological side. It's an art, not a science. And that's the difficult. And that's this part that is really difficult to educate people about. Hey, wait 2 years before we invest it all. Hold on, aren't I missing out? Thankfully, at the moment, missing out means that you're getting 4.5 or 5%. Not a bad deal. Not a bad deal.
High interest savings account and the term deposits. It's probably also worth mentioning that we've kind of just talked about investing a lump sum and that being something to invest, but of course there's going to be considerations for individuals on if they have debt and whether it's worth paying down the debt first or investing and doing those pros and cons. So those are a lot more personal conversations to have.
Right, and that's probably, we miss probably some of that point that people might say, well, we need to do this renovation. We want to go on this holiday. I want to buy this flash car that I wouldn't normally afford but can now. Making sure that it's not all just about money saving for the future. There's got to be that balance. And I think one thing that's really important is the cash buffer, what we call the fluffy pillow that helps people sleep at night, knowing there's a huge cash buffer there, that if something goes wrong, well, there's money there to take care of that.
The emergency fund. And for some people, it might not even be about investing for themselves anymore. They might be looking forward to, future generations and investing for children or investing for grandchildren. And that's, another consideration. And there are ways to do that, definitely.
Cool. Client objectives.
Yes.
Fantastic. Very good. All right, what's next? Estate planning. That sounds like fun.
I just thought it's definitely worth mentioning if this big lump sum of money does affect the balance sheet of your household very much, then it's definitely worthwhile making sure your estate plans are up to date. Wills, power of attorneys, everything.
Cool. Binding death nominations. Because the bulk of the assets could well be in superannuation, and your will does not take care of superannuation. Your binding death nomination does. Fantastic. All right. I think that was a nice, quick discussion.
It was.
if people want to learn more, where do they go?
Go to Investor Motivation on YouTube. There are almost 700 videos there. Podcasts are also posted there if you're a listener but not a watcher and you would like to see us. Otherwise, go to Instagram and TikTok, Robert Gowdy Financial Advice, and the Wealth Diaries on both.
Fantastic. And if anyone's got any questions or a topic you'd like covered, let us know. Thank you very much, and we'll catch you next time. See ya. Bye.